Welcome back, everyone. Today we are going to look at something that completely defies conventional market wisdom. What you see on your screen right now is a 6-year equity curve. But here's the catch. This curve was generated entirely by shorting the Nasdaq futures. Think about the macro environment over the last 6 years. The NQ has a massive, undeniable upward bias. Yet this algorithm has managed to extract a beautifully smooth, rising equity curve by exclusively hunting for localized exhaustion points using a mathematically quantified rounding top pattern. Let us look at the performance metrics to understand the statistical weight of this edge. Over this 6-year backtest, we are not just looking at a small optimized sample size. The system executed exactly 1,199 trades, all on the short side. Out of those, it maintained a highly consistent win rate of 78.32%. It generated over $149,000 in net profit, while keeping the maximum drawdown contained at $23,445. That is a robust, battle-tested distribution of returns. Now let's transition to the chart and unpack the actual engineering behind the pattern recognition. A lot of algorithmic traders struggle to code curved patterns, but look at how the algorithm dynamically draws this yellow arc perfectly over the price action. So, how does it actually define a rounding top mathematically? It uses polynomial regression. If you look at the parameter panel, we use a curvature power of 2. In the code, this forces the algorithm to generate an ideal inverted parabola for various window lengths. It then dynamically scans the recent highs and uses Pearson correlation to compare the real price data against that ideal curve. We enforce a correlation threshold of 0.8. This means that at least 80% of the price variance must perfectly match our parabolic model. You can literally see the algorithm print a 93% correlation score right at the apex of the arc here on the chart, validating the mathematical setup before execution. We also use an ATR period of 14 to measure the depth of the curve. We demand a minimum depth of 4 ATR, which ensures we are trading a significant structural shift and not just minor intraday noise. Once the mathematical conditions for the rounding top are met, the algorithm executes the short. Let us talk about the trade management, because it is highly aggressive and tailored specifically for algorithmic execution. We utilize an inverse risk-to-reward ratio. The fixed take profit is set very tight at 1 ATR, while the stop loss is given a wide berth at 4 ATR. Why do we do this? By keeping the target tight and the stop wide, we capitalize on the immediate breakdown momentum of the rounding top. This prevents premature stop-outs from market noise and drives that 78% win rate. Furthermore, the strategy employs a rigorous martingale recovery matrix. If a stop-loss is hit, the loss multiplier parameter kicks in. In this specific backtest configuration, it is set to 3. This means the algorithm triples its position size on the very next valid setup to aggressively recover the drawdown. Because we have a historical win rate near 80% over roughly 1,200 trades, the mathematical probability of experiencing a deep consecutive losing streak is statistically minimal. This allows the aggressive sizing model to push the equity curve relentlessly higher. It is a brilliant exploitation of market geometry and probability.